Hi, good afternoon. My name is Eric Shuley. I'm part of Team S. We're doing an issues analysis on Starbucks. I'm here to give an introduction and outline as to what we're going to be discussing today, as well as an overview of some of the accounting issues that Starbucks and other organizations similar in size face on a year in, year out basis. So briefly, quick introduction. Starbucks is a US-based corporation that was started in 1971 in Seattle, Washington. Again, initially sold only coffee beans, but expanded to the coffeehouse structure in 1984. Currently employs over 182,000 people and has close to 20,000 stores. Fun fact about it, was named after a character in the novel Moby Dick. The founders of the organization were teachers and writers, and so one of their passions was literature. And one of their favorite stories was Moby Dick. Initially they wanted to name it Pequod, but they settled on Starbucks after the first mate of the ship in the novel Moby Dick. It had its initial public offering in 1992, and currently the growth exceeds that of its competitors such as Dunkin' Donuts, McDonald's, and other fast food restaurants. It's kind of like I guess Wall Street's shining star when it comes to the fast food industry. So real quickly, before I go into these accounting issues, I'll give you a quick overview. I'm going to discuss the accounting issues. I have three that I'm going to talk about today. It's difficult to fit one into a 10-minute presentation, but we have intangible asset valuation such as goodwill and brand name recognition. In addition to that, I'll be discussing a period of time in 2005 when they had to restate their financial statements due to some inappropriate reporting that was done or based on lease holdings that they had. They valued things incorrectly, and they had to restate. And then they're constantly faced with a lot of challenges, such as international being an international business. They're subject to foreign tax issues, and as such, they need to calculate the foreign tax credit properly. So calculating and reporting income tax from foreign earnings is a difficult task, something that Starbucks faces every period, and something that many companies in their situation also face. There's going to be a financial issue that's discussed by Senate moving forward, related to a point of sale system failure back in April 2014. We also are going to have a marketing issue where there were some racial issues in the U.S. that resulted from meetings that they had, and Senate's going to go into a lot more detail specifically on those. Trendell is going to speak about the operations issues that we're facing, that Starbucks is facing, apologies, and one of the functional issues related to human resources and labor, and some of the I guess things that are upsetting the employees, things that employee issues that are being reported and seem to be falling on deaf ears in this, from a corporate perspective. Then I'll touch on the recommendations and the conclusion in part 4 of this video series. So focusing on the accounting issues, moving back to that, it's intangible asset valuation, as you can see on the screen here. When discussing assets that are owned by a company, most thoughts go directly to actual physical goods that can be sold, products that a company deals in. Other people may think of real estate that a company owns or some sort of other tangible asset like inventory or equipment. But a lot of people don't think about the intangible assets that make up a company's value. And a company like Starbucks, brand recognition and name brand value is very high. It's almost as recognizable as, if not more so than some fast food restaurants that everyone knows about. McDonald's is probably the only one I can think of that is just a more recognized brand name. But, the likes of Pizza Hut and Burger King, Starbucks is right up there. And the loyal customer following there definitely, they see that sign, they know what they're getting out of that particular establishment. So it's been reported to be worth over $1.5 billion, Starbucks, the brand recognition. Providing an accurate valuation of this type of asset is difficult. It can be tricky. So there's not only significant value in their own brand. When you're talking about a company like Starbucks, they also own other companies that have brand recognition of their own, like Tazo and Seattle's Best Coffee and Tivana. And so trying to accurately determine all of these, the valuation of all these brands and their goodwill is applied against other firms that are owned by Starbucks takes time. So, you have to determine the amount of useful life. You have to determine the amount that you would pay for an asset, or the amount that an outside organization would pay for that particular asset. And we have to discuss, the portion of operating income that's generated as a result of that particular intangible asset. You want to be very careful, not overstate or understate, because that leads to restatement of income statements and profit and loss statements. This type of issue is, not limited just to Starbucks. And so one of the ways you can overcome the difficulties in valuing your internal let me back up a second. External tangible assets, that's very simple. When you purchase an organization or a company, it comes with an intangible asset. Basically, you value that depending upon what you pay for that organization. So if you're willing to pay $1 million for it, then that's really what the value of that is in the fair market. When it comes to an internal intangible asset, it's a lot more difficult, particularly because you have to parse out the part of operating expense that is related to the development of that particular asset. And so, normally an external intangible asset will be amortized over the life of the expected life of that asset. For internal asset, it's much more prudent to expense that. That way you don't have to separate out those operating expenses. So the recommendation for Starbucks in this case would be to record it as an expense rather than a capitalized amortized expense. In 2005, Starbucks was forced to restate its net income due to accounting issues related to lease holdings of the organization. Starbucks performed an audit, and they found, along with other organizations at the same time, like Wendy's and Darden Incorporated, that they had incorrectly accounted for tenant leasehold improvements and rent holidays funded by incentives from landlords. So Securities and Exchange top accountant came back and said, well, we need some more information on how you're accounting for that type of for these leasehold improvements. And as a result, they found that they're $12.6 million over on their net income reporting over the period from 2002 to 2004. So they basically had to go back and restate their 2002, 3, and 4 fiscal profits. As a result, the total yearly earnings in 2002 were reduced by about $8.6 million, with the remaining balance spread over the course of the additional years. Things like this are time-consuming and costly, but in order to be in compliance with the Sarbanes-Oxley Act 2002, that it requires accurate disclosure. And while this $12.6 million may seem trivial for an organization like Starbucks, when they're in the billions and billions of dollars of revenue per year, and it had very little effect on the EBITDA for a company like Starbucks, in order to be compliant with SOX, it's something that had to happen. So they saw a share price drop of 12 cents per share at a similar period of time for when they reported this earnings misstatement. Recommendation is really to make sure that they focus on providing the right type of training for their accounting team to watch out for things like this, to constantly reevaluate the methods that are being used. Large corporations like Starbucks are also faced with additional challenges, such as, calculating and reporting income tax and foreign earnings. As a U.S.-based company, they're subject to, a worldwide income tax system that must be followed in every case and for every facility. And non-American companies don't have to face these types of problems. But they are, the foreign tax credit is something that's an option and it's available to Starbucks. And so as a result, what they need to do is to actually calculate the foreign tax credit offered to companies, in this type of situation. They need to have accurate foreign records. And so right now, it's easy to identify the earnings and expenses incurred in each country, but in order to appropriately put that in the right place on every financial statement, it becomes difficult. Different countries have different practices they follow. So the recommendation, and this is something all U.S.-based global companies, face, an issue they all face. So the recommendation for Starbucks here would be, to prepare a standardized tax preparation worksheet that would allow for the accurate reporting of all that information in one place at one, so that each entity reports back in a similar manner. It makes it easy for the accounting team to consolidate all this information, so when it gets back into the hands of the U.S.-based firm and the U.S.-based accountants, when they go to report, they can easily identify inaccuracies, and it can lead to a reduction in reevaluation of work. I'm going to pass it over to Sinead now and let her go through her portion of the financial issues, marketing issues. I believe she's going to touch briefly on the accounting issue back in 2005 also. So, thanks.